Good afternoon, my name's Craig Earle, I'm market analyst at ALPARI UK, and welcome to today's daily market update. Today we're going to look at the major stories moving the financial markets, and this focuses today around the US. Now tonight we have the Fed minutes from earlier this month due to be released. Now this will tell us how many of these Fed members, how many of these policymakers are actually in favour of QE or were in favour of QE at the beginning of this month, which should give us some indication as to whether the Fed are seriously considering QE3 at the start of next month at their meeting on September 2nd. So there's going to be a lot of focus around these minutes. If we do see some kind of lean towards QE from many or even a few of the policy members, we may actually see the dollar drop off slightly, obviously with the anticipation. We have seen the dollar make some gains since over the last couple of weeks with positive data out the US indicating we may not actually see QE again this year. So like I said, there's going to be a lot of focus on these minutes and especially we should see some heavy movement in the currency charts. And if we look at the euro so far today, we can actually see that it is trading around flat. It is awaiting these minutes. It's trading around 124.70 so far this morning. We have seen a nudge higher pushing on towards 125, but it has started to pull back in, like I say, trading flat about now. We should see some movement later on today as we approach the minutes once the rumours start to come out more. In the cable charts, we have seen sterling break above that ascending triangle that it's been trading in over the past couple of weeks. Yesterday it broke above this triangle and again and closed above here. Today we have actually seen it push towards that 158 where it has found strong resistance. However, as long as we can see a close above this ascending triangle, it will confirm the breakout, which means we should see a move in these charts towards 160 maybe over the next couple of weeks. Elsewhere, the major stories are coming out of the Eurozone. There's been a lot of focus on Greece over the last couple of days with the Troika to visit the Greek government at the start of September in order to find out if they are sticking to these planned austerity measures that they are having to implement in order to receive the next tranche of this bailout, thought to be around 31.5 billion euros. The cuts they're going to have to reduce their fiscal target, have to meet the fiscal target, reducing their spending by around 11.5 billion euros over the next couple of years. Obviously, we've seen a lot of cuts already in Greece, so this isn't as easy as you'd expect, and there is a lot of resistance from the government. They are looking to try and renegotiate the terms of this bailout with the Troika and with their creditors, trying to get an extension, not necessarily to reduce the cuts being made, but to get an extension on how long it takes to implement them for at least a couple of years. Like I say, Greece are in a heavy recession now. They have been for a long time and they don't look like exiting it. Unemployment's reached almost 1 in 4, so any more austerity measures really is going to severely hit the country, and this is what the new Greek government are trying to resist. They are using the extended election earlier this year as an excuse as to why it's taken so long to implement these measures. So like I said, they are going to try and renegotiate it to try and lessen the impact on the Greek economy. Other than this, we're going to be looking towards Spain. Now, we do know Mariano Rajoy is planning to request some aid of some kind from the Eurozone, whether it's going to be aid to reduce the bond yields by using the EFSF to purchase bonds in the secondary market, which could potentially be backed up by the ECB. We have obviously heard comments by the ECB over the last couple of weeks which suggested we are going to see bond buying of some kind. A couple of weeks ago, people thought it was the resumption of the securities markets program after Mario Draghi's comments saying that the ECB were going to do whatever it takes to preserve the euro, and stating that these increasing bond yields or controlling them is part of the ECB mandate. We have heard a lot of opposition towards this from the Bundesbank in Germany, and we have had some comments over the last couple of days which have suggested that these claims have been rejected by the ECB. But if you actually look at the comments, they've actually very cleverly come up with these comments. They have actually stated in the last couple of days that it's not the fact that they haven't exactly rejected these claims. They've chosen the words very carefully, saying it's misleading to report on policy decisions that have not actually been made. So like I say, very cleverly chosen words. That's not so much the rejection that has been reported in the media, so we do actually still expect to see some form of bond purchases by the ECB over the next couple of weeks, probably in tandem with the EFSF. And like I say, Mario Draghi also hinted that it would be towards the shorter end of the yield curve, so probably buying these around the 2-year bonds as opposed to the 10-year treasuries. Other than this, we could also see Spain actually request a full bailout from the Eurozone. However, this is less likely, as it is likely to come with more strict austerity conditions as opposed to potentially these bond purchases in the secondary market. But like I say, we'll surely find this out over the next couple of weeks. For now, all we're looking ahead towards is this Fed Fed meeting minutes later on today. So for now, my name's Craig Earlham, market analyst at ALPARI UK. Thank you very much for joining us.